Do you want to know if you should buy an investment property in cash? Does it make sense to trap a good chunk, if not most of your money in just one deal? In this video, I want to help you understand why using a mortgage to purchase investment properties makes much more sense than buying them in cash. I will also pinpoint the 4 main advantages of doing this and show you how beneficial this can be for you as a property investor, so stay tuned. Hi guys, my name is Marius and welcome to Money Employed. If this is your first time here, please consider subscribing and make sure you hit that like button because it really helps out the channel with the YouTube algorithm. Now before we start off, I just want to make it clear that the content of this video is for educational purposes only. So should you buy properties in cash or use a mortgage? This is a question to which sometimes people struggle to find a good answer. I was actually talking to a former colleague from university about this subject a while back, and I thought this might be a great subject for a video. He was telling me that him and his dad buy properties here in the UK, but they buy them in cash for a number of reasons. And I kind of had like a different perspective on the subject, and that got me thinking. On one hand, it makes sense to buy something in cash because 1, you own it outright, 2, you don't pay any interest on your purchase, and 3, you kind of get a sense of relief and security. On the other hand, however, when it comes to purchasing investment properties, you want the money you invest to 1, work as hard as possible for you, 2, get you the best return, and 3, recoup that money back as quickly as possible so you can go on and invest it into something else, maybe another property. And using a mortgage is a great way to make your money work harder for you because you're taking advantage of leverage. And in fact, property is one of the easiest assets to leverage. If you don't know what leverage is, let me quickly describe it for you. Basically, leverage is the use of debt, aka borrowed capital, in order to undertake and amplify the returns of an investment or a project. There are actually multiple types of leverage, but I can talk about those probably in a future video. Let me know in the comments below if that's something you would like to see. Anyway, in the most simple terms, if, for example, you want to purchase a, let's say, £200,000 investment property, instead of needing to have the whole amount in cash, usually what you would need is a 25% deposit, which in this case would be £50,000, and use leverage to pay for the remaining 75% by getting a mortgage of £150,000. Now, in the UK, most, if not all property investors will use an interest-only mortgage, and it's this type of mortgage that I will be referring to in all of the following examples. And if you don't know what an interest-only mortgage is, basically it's a type of mortgage where for the duration of the loan, you only pay interest on the money you've borrowed, which allows you to reduce your monthly cost and therefore increase your cash flow. But here's where things start to get interesting, and we'll see why leverage is such a powerful tool. So to use the previous example, although you would only have 25% of equity in this investment property, if the value of the property increases to, let's say, £220,000, you are entitled to 100% of that £20,000 capital appreciation and not the bank, even though technically the bank invested more money in that property than you have. Now, for those of you who don't know what equity is, here's a simple explanation. Equity in a property is the difference between the fair market value of that property and the amount of money you owe to the lender, for example, if you have a mortgage. So going back to the previous example where you bought a property for £200,000 by putting down a 25% deposit of £50,000 and getting a 75% mortgage of £150,000, if in the next 3 years, the value of the property would go up to, let's say, £220,000, your equity in this property will go from 25% to 31.81%. Because remember, you are entitled to 100% of that capital appreciation, which in this example is £20,000. Basically, now you would have £70,000 of equity in this property, £50,000 from your deposit, plus £20,000 from capital appreciation. To calculate your equity as a percentage, all you have to do is take the current market value of the property, which in this case is £220,000, minus the mortgage on it, in this case £150,000, and then take what's left, £70,000, and then you divide that by the current market value of the property and multiply the result by 100. And that's how I got the 31.81% in equity. So in case you would decide to sell this property, you would make, in principle, £20,000 in profit. Now, of course, you won't get all that profit because there's capital gains tax and other fees to pay, but you get the idea. So I hope this clears things up about equity and what it is. Let's now look at an example and see how using leverage to buy investment properties makes much more sense. So let's say you have £100,000 in cash to invest in property, and because there are other costs involved when buying properties like stamp duty, solicitor fees, etc., the purchase price you're looking for is £95,000. We'll first run the numbers on this property as a cash purchase, and then we'll compare them to using leverage to buy the exact same property. So the purchase price is £95,000. The stamp duty for this purchase will be £2,850. To calculate this, I've used the stamp duty calculator from a website called Money Advice and Services. I'll put a link to it in the description below if you want to check it out. The other costs involved for the cash purchase are solicitor fees, which in this case will forecast a realistic £1,000, a RICS survey of £450, and will forecast another £700 for any extra costs, just in case. If we add up all these amounts, we get a total money in of £100,000. Right, now let's look at how different our numbers are going to look if we're going to use leverage to buy the exact same property with a mortgage. Again, the purchase price is £95,000, solicitor fees £1,000, £450 for the RICS survey, £1,500 in mortgage costs, and again the £700 for extra costs. To stress test the numbers, let's assume we'll get a 3-year at 5% interest only fixed rate mortgage for 75% of the value of the property. As we're getting a 75% loan to value mortgage, that means we need to put down a 25% deposit. To find out how much money we need as a deposit for purchasing this property, all we have to do is take the purchase price, in this case £95,000, and multiply it by 0.25. From doing that calculation, we find out that the deposit we need to put down for this particular property is £23,750. This means that the amount we'll have to borrow from the lender in the form of a mortgage is the purchase price £95,000 minus the deposit £23,750, which gives us £71,250. So our total money in figure when using leverage is £30,250. So now let's look at how this property can perform in both scenarios based on an achievable rent of £750 a month. In our cash purchase example, it would look like this. From the £750 in rent, we'll need to take off a typical 10% in management fees, which will be £75. We'll put aside 10% in maintenance and voids, so another £75, and let's say £15 for property insurance. Since the property was fully paid for in cash, there isn't a mortgage payment to deduct from the rent. So the monthly cash flow is £585 and the yearly cash flow is £7,020. In the example where we use a mortgage to purchase the property, the numbers will look slightly different. So again, we have the monthly rent of £750 minus £75 in management fees, minus £75 for maintenance and voids, minus £15 for property insurance, and minus £297 in mortgage interest payments. To calculate the monthly interest payments, all we have to do is take the amount borrowed, in this case £71,250, multiply that by 0.05, which represents the 5% interest, and divide the result by 12, which represents the numbers of months in a year. So in this example, we are left with a monthly cash flow of £288 and a yearly cash flow of £3,456. Now, if you think about it, in this example, we're actually making half less in cash flow than we did in the previous example where we purchased the property in cash. And I said earlier that using leverage will amplify your returns, but that clearly isn't the case, right? Well, we don't see the whole picture yet because we haven't calculated the return on investment for each example. And using leverage gets even better when you analyze the results from the point of view of return on investment. To calculate the return on investment, all we need are the yearly cash flow and the total money in. So in our cash purchase example, we had a yearly cash flow of £7,020 and a total money in of £100,000. The formula to calculate return on investment is yearly cash flow divided by total money in multiplied by 100 to give us a percentage. So if we divide £7,020 by £100,000 and multiply that by 100, we get 7.02%, which is not a great ROI, but it's still better than what you'd receive from keeping £100,000 in a regular bank account. And I think we can all agree on that. Now let's calculate the return on investment for when we use leverage to purchase the property. In this example, our yearly cash flow was £3,456 and the total money in was £30,250. So 3,456 divided by 30,250 multiplied by 100 gives us a return on investment of 11.42%. Now I know what you're going to say. The return on investment is not so much higher compared to the 7.02% in the cash purchase example. But here's the thing, the interest rate we used was about 2% higher than what most investors can get on a very similar mortgage product. What I want you to do now is pause this video and run the numbers to see how much the monthly mortgage payments would be if the interest on the mortgage would be 3% instead of 5%. You should be able to calculate a new monthly and yearly cash flow figure, as well as a new return on investment figure. So go ahead, pause the video, do the calculation, post your answers in the comments, and then carry on with the video to see if you got it right. If your result was £407 in monthly cash flow, 4,883 in yearly cash flow, and 16.14% return on investment, then congratulations, you got it right. If you got completely different numbers, go back through the calculation and see where you made the mistake. Now, if you think about it, 16.14% ROI is more than double what you would get if you were to purchase the exact same property, but in cash. And if that's not crazy and exciting, I don't know what is. So what can you do with this knowledge? Well, if you think about it, you can use the same pot of money of £100,000 and purchase 3 similarly priced properties that can achieve the same amount of rent. Remember, this is meant to be just an example so you can understand how the numbers work. However, if you were to buy 3 such properties, your total money in would obviously triple to be £90,750. Your monthly and yearly cash flow would also triple to be £864 and £10,368 respectively. The ROI would stay the same because the ratio between the yearly cash flow and the total money in doesn't change. So here are the 4 main advantages of using leverage to purchase multiple investment properties. Essentially, by doing this, you would 1. Increase the amount of cash flow you make each month and year. 2. You spread your risk amongst 3 properties and not just 1. So if one of the properties becomes vacant for a few months or so, you still have 2 other ones that are bringing in monthly cash flow that's enough to cover the costs for the 3rd one, so that you don't have to pay for the costs out of your own pocket. 3. You can achieve a better ROI with less money invested, as you would actually be left with £9,250 out of your initial pot of £100,000, which you can go and invest in, let's say, a rent-to-rent deal, or JV with another investor on a completely different deal, or even treat yourself to a nice holiday for doing such an amazing job and investing in a smart way. The last benefit of doing this is that you would benefit from capital appreciation from 3 properties instead of just 1. So let's be conservative and say that on average, over the next 5 years, the value of each of the 3 properties goes up by £15,000. You will have made an extra £45,000 instead of just £15,000 if you were to own just 1 property. Now, capital appreciation is not guaranteed, but property prices in the UK tend to go up over time because of a shortage of houses and an ever-growing population. In some cases, house prices tend to even double every 10 years or so, but that shouldn't even be part of your decision-making process because it's not something very common. So basically, any way you look at it, in my opinion, it makes much more sense to use that pot of money to buy more than 1 property. Now, I understand that this means to use debt, which scares a lot of people, and for good reasons, but as long as you use debt responsibly, in a smart way, and for the right reasons, i.e. investing in a real cash flowing asset, you can get ahead much quicker. I really hope you guys enjoyed this video and have gotten a lot of value out of it. If that's the case, please make sure to hit the like button and comment below to let me know your thoughts. Besides videos on business, money, and other similar topics, I will begin to post videos about my property investing journey on this channel. So if that's something you'd like to be part of, please make sure to subscribe to the channel and hit the notification bell so you stay up to date with the content. Thank you so much for watching, and I'll see you guys in the next video.